All right, well, I'm Matt Sorensen, as I was introduced. I appreciate the opportunity to be here. I'm going to be talking about self-directed retirement accounts and how they can invest in real estate. This is my passion. That actually was an old bio. I wasn't joking. I don't know where that bio came from. But this is my book, the Self-Directed IRA Handbook, that I'm most known for. It sold 20,000 copies. It's the #1 book in the industry. Every company in the industry uses the book. The National Association in the industry uses the book to certify people in the industry. They take a test and stuff after training. But I have my own company, Directed IRA, that I'm the CEO of, where we custody people's self-directed accounts. So I've been an attorney in the field for a long time doing it. This last year, my partner, Mark Kohler, who's speaking against me over here, is my partner in that company. So, all right, well, let's get started. I'm an attorney, and before we get started, I just want to remind you, don't rely on anything I tell you, okay? This is not constituting an attorney-client relationship, and go seek out licensed professionals when conducting actual transactions. Okay, I mentioned that a little bit about me. That's my book. That's the company's. I'm a partner in KQS Lawyers. We have an office here in Utah. I'm in our Phoenix office. Mark, who's also here, is in Idaho. And then we have an office in Southern California, too. Okay, let's start talking about this. So I think a lot of real estate investors come to these presentations and they're like, why is the guy here talking about retirement accounts? And there's really 28 reasons why we're talking about this. It's really 28 trillion reasons why. There's $28 trillion in real estate. Sorry, there's $28 trillion in retirement accounts in the US. And I think a lot of people don't realize that this is the largest place of investable cash, period. There's no other place that's got more money than US retirement accounts. So if you're trying to fund a deal, do you want to know these rules? If you have your own little sliver of this money, do you want to know how you can use that money to invest in real estate or stuff that you may know more about than buying a crappy mutual fund? So that's why I want to talk about it to this group. The very first time I got involved in this was in 2006. I had a client. He was this really sophisticated real estate developer in Texas, and he bought an option on a property with a Roth IRA. He used a Roth IRA, which happens when you sell something in a Roth IRA, the money goes back into the Roth IRA and you pay no tax, and then it comes out when you retire totally tax-free. So it's like the only tax-free vehicle. So he bought an option on a piece of land for $10,000. He had the right to buy the property for 5 years under the option. Now, he knew there was going to be real estate development in the area and that the state and the county had planned a freeway interchange going by this property. That's why he went and got the option on it with his Roth IRA. 3 years later, the freeway interchange goes in. The property is no longer agricultural property. It turns into freeway commercial. So he goes and sells the option now because the price of the property went up over $1 million. So he sold the option in his Roth IRA for over $1 million. And I was helping him through this transaction, and I was always like interested in retirement accounts. I'd kind of heard of it. We had some clients doing it back in 2006. And this is the one that opened my eyes. So I'm like, wait a second. This guy just sold an option. He only put 10 grand down with the Roth IRA. He got $1 million profit back in his Roth account, totally tax-free. And for this client, he was like pissed. He was pissed at his CPA, his financial advisor, his other lawyers that he worked with, because he was very successful and he knew how to make money. But none of these people told him you could do this with a retirement account. And he's like, they're telling me to invest my retirement account in the stock market. I don't know crap about that. They know my tax returns. They know how wealthy I am. They know I do that all in real estate. Why didn't one of those idiots tell me I could have just used a retirement account and done this in a more tax efficient way? And so when that came through, this deal closed, I was like, that's it. I'm doing this from here on out. This is going to be my specialty, and that's what I focused on in my law practice. But I just want to give a few points on this first, though, is if you think of a retirement account, think of just an IRA or 401k. Let's just hit a couple basic characteristics of them. I'm really going to talk about how you invest this in real estate or notes and stuff like that, but I just want to make sure everybody understands the benefit of a retirement account. If I have Facebook stock that I bought for $100,000, it goes up to $150,000, I sell it for $150,000 in my IRA. That $150,000 goes back into my IRA, and I pay no tax on the gain, right? It's in an IRA. And if it's a traditional IRA, it's just growing tax deferred. When I reach retirement, I pay taxes, I pull money out. If it's a Roth account, it grows tax-free, and I pull out the money tax-free at retirement. So both of them are like tax favorable, okay? So, but the benefit is when I sell an asset, I don't pay tax on the gain, right? In a retirement account. Well, it works the same way in real estate. If I bought a property with my IRA for $100,000, I sell it for $150,000, that $150,000 goes back into my retirement account, I pay no tax on the gain, okay? So it's the same concept. So because a self-directed retirement account can be used to buy real estate and notes, we're trying to make sure everybody who does real estate knows about this because we want you to invest in what you know and what you're good at. So I give these presentations everywhere, and Mitt Romney's in my slides. He's the senator now here, right? So when he ran for president, though, this was a pretty big topic. He had an IRA worth of reported $25 to $100 million that he had to report on his presidential disclosures. And so the media is like, how can someone have such a large retirement account? You can only put in $6,000 a year into an IRA. And back then, when he was doing it, you could put in way less. Well, he wasn't investing in mutual funds in the stock market. He was investing in small companies that they were helping or consulting with, like Staples when it was one store, and he was investing in what he knew. And they were getting excellent returns on the investments. That's why he had such a huge IRA. So also, Peter Thiel, if you're familiar with Peter Thiel, he has the largest retirement account, period. If you've somebody seen the movie The Social Network, okay, The Social Network's about how Facebook started. There's this scene in The Social Network where they get their first investment of outside money. And it's this kind of controversial scene. They've kind of got this new office, and they're becoming a big company now. And this investor comes in and invests money into the company. It's the first outside money they take, and that guy was named Peter Thiel. He was the founder of PayPal. He's a very famous tech investor. Well, he invested with his Roth IRA. Facebook, the first outside money in Facebook was a Roth IRA. That's now worth over $1 billion, that guy's account. So, and that's tax-free, by the way, in a Roth IRA. So there's a lot of people that use retirement accounts to invest in what they know. Now, you may be into tech, you may be into private equity, you may be into real estate. My point is, why are you just buying a mutual fund with your retirement account? Like, a lot of people are like, well, I just want to be in the market, and I get that. But if you can make good investments, you might as well use your retirement account to do it. Okay. I want to just illustrate a couple of points, and I'm going to take a break here for questions. But the first thing to understand is, let's say that, what's your name? Coco. Oh, that's right. Okay, Coco. Okay. Sorry, we've met. So let's say that Coco wanted to buy real estate with her IRA. She's like, I got an IRA at TD Ameritrade. Now, if you go to TD Ameritrade and you call them up and you say, hey, there's this fourplex I want to invest in. There's this person I want to loan money to on a real estate deal, and I want to do that with my IRA. TD Ameritrade or Fidelity or whoever your account's with is going to say, you can't do that. And what they mean by that is your account at TD Ameritrade cannot do that. Retirement accounts can own real estate. They can own a single-family rental. It can own a property that flips. It can own a note on a property. It can invest in an LLC. It's just that an account at TD Ameritrade can only buy stocks, bonds, and mutual funds. So when retirement accounts were first started, what happened was the financial services industry realized people were really putting money into these things because they were first just going into like banks and credit unions. Well, the financial services industry is like, oh my gosh, people are dumping a lot of money into these. We're going to open up accounts and we're going to let them buy the crap that we sell, or whatever. We're going to let them buy what we sell. So like all the financial institutions, the broker dealers, they started setting up retirement accounts. Voila, that's where everyone's money's at now. And so people think you can't do that just because everybody's account generally is a place that doesn't let you do it. So the first thing you'll have to do is you just need to change the custodian. Don't be at a broker-dealer that makes you buy broker-dealer product. You can move your account to a self-directed IRA custodian. There's like 30 of them out there. That's like my company-directed IRA is one of them. And you roll your money over there, you set up an account there, and then you can buy real estate. You're not restricted to stocks, bonds, and mutual funds. So the problem is, it's like when you go call Fidelity or Merrill Lynch and you say, hey, I want to buy real estate with my account, and they say no, it's kind of like you went into Arby's and you asked for a chalupa, It's not that you can't have a chalupa, you're just at the wrong place to get that, okay? So you need to get out of Arby's and go to Taco Bell because they have chalupas, okay? That's like real estate in your retirement account. So you'll have to move custodians, so you move your account to a self-directed custodian who lets you do that. So now if you say, all right, I want to buy a rental property. Let's say you want to buy a rental property with your IRA. You move it from where it's at now. Now you have a self-directed IRA or self-directed retirement plan. Now the retirement account buys the property. Now this property has to be held for investment. Okay, this is not a property you're going to stay at. This isn't a second home. Your kids aren't going to stay at it. Okay, this is an investment. It needs to produce investment income like rental income or capital gain if you sell it for a profit. Now the retirement account's on title to the property. So like if your account's with us, like let's say this is Matt Sorensen doing this, it's not Matt Sorensen buying the property. It's Matt Sorensen's IRA buying the property. So on the contract to purchase, it'll be Directed Trust Company, FBO, Matt Sorensen, IRA. And then the IRA custodian, like in my case, our own company, we would approve the sale, and we would process the money to title or escrow to buy the property. When there's rental income, it goes back to the IRA. When there's expenses, the IRA pays the expenses. Okay, everything's happening at the IRA. This isn't you don't own it, your retirement account does. And it'll stay off your personal tax return, it's not taxable. Okay, this is building up in your retirement account. All right, now you can buy multiple properties, you can do notes and stuff, which we're going to talk about. But any questions so far on a self-directed retirement account? Yes?
So does your self-directed retirement account have to buy the property 100%, or can you do a down payment with your self-directed IRA and then use a lender?
I got a slide for that. I'll just wait on that one, but it's a good question. The short answer is yes, you can get a loan, but you got to do it in a special way. So, and one thing I'm going to say about this too is, I think some people are like, sometimes I get these rules and that, my book's got 19 chapters in it. I'm kind of a nerd, so I geeked out on it. I put all the tax code citations in it to make people feel like, oh, this guy didn't shoot this off the cuff. But it's not hard. I tell you, it's just like playing a new board game. If you just sit down and start playing it and nobody told you how to do it or you didn't read the manual, you're going to screw it up. You're going to do it wrong. The problem, if you do it in your retirement account, it causes taxes and penalty issues. So you just got to make sure before you play the game, you know the rules, you play with someone you know, or you read the book, so to speak. So, so don't get too overwhelmed with these rules. All right, so simple enough, retirement account owns the property, retirement account gets the income on the property, retirement account pays the expenses. Now we're going to show options where you can use an LLC in the middle too as well. You could also do a note. We have a lot of clients who retirement accounts, and my own retirement account owns rental real estate that I actually bought from Steve Olson through FIG. And also you can do private money lending, which I also do. So if you're doing private money lending, what happens is the IRA is the lender on the note. The IRA is getting back points and interest. Okay, easy enough. You're just playing, hard money lender with your IRA. That's a very common, very popular self-directed investment. Okay. Okay, you can always roll over money. So like I said, if you have the account at Charles Schwab or TD Ameritrade and you want to move the money over, there's a lot of different ways you can do it. You can do what's called a trust. Like if I have a Roth IRA at Merrill Lynch, I can move that to a self-directed IRA. If I have a traditional IRA at my credit union, I can move that to a self-directed IRA. If I have an old employer's 401k plan, it's called the direct rollover, I can roll that over to an IRA. If I have a 401k with an employer I still work at, and I'm 59 and a half or older, I can roll that over to an IRA. Now, one place where people get stuck, though, is if they have a self-directed retirement account, they're under 59 and a half, and they still work, they have a 401k, they still work at the place, and they're not 59 and a half yet. So let's say you're 40, you have a 401k at work, you're stuck. Until you quit, you're stuck in the company's plan. They're not going to let you move it out somewhere. And I've seriously had people quit their job to move their money in their retirement account. Some of them have gone back to work the next week. But so I don't recommend that, but some people are determined to do this. So, but if you're over 59 and a half, even if you still work at the company, you're generally able to roll out the money. Yes?
Can you combine a traditional IRA and a SEP IRA into one?
Yes. Yes, you could, if you have a SEP and a traditional IRA, you can move those into one self-directed IRA that you can use to go do this. And you probably just do a traditional IRA, because the SEP can roll into a traditional. Yes?
As a private lender, if you have to take back an asset, how
Yes.
does that work with your IRA?
Okay, question, as a private lender, if you have to take back the asset, how does that work? So, if hopefully you got a mortgage or a deed of trust, you know. So if you have to foreclose, the IRA forecloses, the IRA takes the property back. Excuse me, and now the IRA is on title. The IRA owns it. Or it could have sold it at auction.
Third party, if you hang on to it, the third party management, right, you can't personally.
Yes. So another important rule is, and I'm going to get to this, it's called prohibited transactions. If your IRA owns real estate, like let's say you have a rental property, you're restricted from physically working on it. You can go and look at it or tell a contractor what to do to fix it, but you actually can't physically make improvements to real estate your IRA owns yourself, because it's deemed to be services that could be a contribution to the retirement account. It gets into complicated retirement account tax problems. But the IRA could obviously pay some third party to do it, a handyman, whatever, to go fix things, or a property management company that handles that stuff. That's all fine. Now, I think some people are really surprised because there are very limited restrictions on what a retirement account can buy. These are the only 3 asset types you cannot buy with a retirement account: collectible items, life insurance, and S corporation stock. Those are the only things a retirement account cannot buy. Now, we have a lot of real estate clients that may be interested in S corporations, but you can do LLCs all day long, and we do a lot of LLCs with IRAs. Life insurance, probably won't look into that with an IRA. Collectibles, this was one that was, when retirement accounts first came out, you could invest in collectibles. People would buy like art with their IRA or retirement account. They were buying antique cars that would kind of disappear on the weekends and come back. They were buying wine collections that turned into bottle collections. And so like the IRS had to come down and, say, no, you're not doing this anymore. You just can't buy collectibles. There's too much potential for abuse. But that's it. So what happens is the big rule you have to know about when you self-directed retirement account and you want to buy real estate, you want to partner in with other people, you want to maybe use some personal money and some IRA money, or use your account and your spouse's account. And we're going to go through that. But the biggest rule you need to know is called the prohibited transaction rules. But that is a rule that has to do with whom your account is transacting with, not what you're buying. So the prohibited transaction rules is concerned about if my IRA is buying something, who's it buying it from? Or if it's selling an asset, who's it selling it to? Or if it owns an asset, like a rental property, who's it leasing it to? Or if it loans someone money, who's the borrower? Like, they want to know who's on the other end of the deal. And what the reason they want to do that, and this is when Congress created retirement accounts, they're like, these are tax favorable accounts. We don't trust people with them. We know they're going to screw us out of tax revenue. And if there was a way, I would tell you how to do it. But there's this rule that says you can't. So basically what it boils down to is your IRA cannot transact with certain people on this disqualified list. That includes yourself. So let's say I own real estate myself personally. My IRA can't go buy that real estate from myself. That includes my spouse, my parents, and my kids. And there's a longer list here, but essentially that's the first type of prohibited transaction. It's called a per se prohibited transaction, and it occurs when your IRA transacts with someone who's called a disqualified person. And remember, the owner of the IRA is disqualified, their spouse is, their kids are, their parents are. Now, if you're just buying real estate out on the market, family's not involved, you don't need to stress about this. But sometimes we have clients that are deal makers and they've got stuff going on and they're trying to push this rule. Or they've got family members or other accounts involved in the deal that they want to all invest in it. And that can work, but you got to be careful. Now we'll come back to this, but here's who's disqualified. Yeah.
I guess I'll ask my question after this slide.
Okay, all right, okay. Okay, so here's who's on the disqualified list. You as the owner of the account, your spouse, your kids, your spouse's kids, your grandparents, parents, grandparents, any companies these family members own 50% or more of is also disqualified. So, what's your name? Casey. Okay, let's say that Coco, Casey, and Matt each own 1/3 of an LLC. That LLC owns a property that we went and rehabbed, and we're flipping it now. We're going to sell it. And let's say that, we're not related, right? And let's say that I decide, I want my IRA to buy that. I want to buy that as a rental from the LLC. Could my IRA transact with the LLC and buy the property? What do you think? I own 1/3. Casey owns 1/3. Coco owns 1/3. Yeah? Okay, yeah, because I'm not over 50, okay? But let's say that Coco and I were spouses. Now we're over 50. We're 2/3, Casey's 1/3. Now can my IRA buy from the LLC? No, because we've gone over the 50% rule. So it basically is saying if these people that are disqualified control the company, and control for the IRS is 50%, that LLC is disqualified too. Yeah.
Okay, so I have two questions that are related. One is, if you buy out, let's say Coco, it's not your spouse, but
Yeah.
you buy out Coco,
Okay.
after you do the deal, what happens with your IRA? Now, you do the deal, your IRA owns it, but then you buy out Coco because Coco wants to sell it for whatever reason, then what?
So I'm confused on the facts. The first we have 1/3, 1/3, 1/3.
Right.
And it's me personally.
You do the deal, the deal's done, you own the
The IRA bought it.
the IRA bought it.
The IRA bought it. Okay. The IRA owns the property
Your
now.
IRA bought it and they paid their own cash, right, or whatever.
Oh, so, okay. You're saying let's start over. You're saying.
Three separate individuals. Your IRA put your money in for
Okay. Okay.
and then they bought it however they wanted.
Okay. They use their IRA. They personally put. Okay. Cool.
So then,
I'm good with that.
right, so now you guys own an apartment complex.
Yes.
And then Coco says, I'm out.
Yes.
You can buy me out.
I can buy her out.
You can buy, your IRA can buy her out?
Yes. I mean, she's not my spouse
Right.
in this scenario.
Now you own over 50%.
Then it's cool. The 50% rule.
Okay.
The 50% rule is misinterpreted and enforced at many companies in the industry because they don't understand it. The 50% rule has nothing to do in that situation.
Okay, so here's the other part. So I'm part of a family.
That was a good question, by the way, because a lot of companies you'll call will like hit the buzzer on that and be like, can't do it. But it's because some of them are morons. Go ahead.
So I'm part of a family company, and I don't own 50% of we have a management company, development,
Yeah.
so we kind of do everything from development to property management. So,
Okay.
could I have my IRA invest in one of our deals that I also manage? We hire a general contractor, we hire out everything except for the property management. Does that?
How much ownership do you have in the family property management company?
Well under 50%.
Okay. Well, I'd have to add up in that family how many people are on this list to your IRA, like your parents, your spouse.
It's all family.
If this list of people to your IRA went over 50%, you wouldn't have a prayer. If it's under 50%, it's possible. It's kind of more of a consult question. But it's called self-dealing is what it could fall under. Because let's say you get around this rule like we had here. The other issue you have is what's called self-dealing. If you're making money on deals that your IRA is doing personally, the IRS could call it a self-dealing privilege transaction. Let's say that my IRA buys a property that I Airbnb. And there's 1 week nobody's staying there. And so I'm like, I'll just go on vacation. I'll just go stay there myself with my family. My IRA owns it. Nobody was gonna stay there. I was not losing money. So I go stay there. Well, you just benefited from your retirement accounts investments. That causes a self-dealing prohibited transaction. Also, let's say you have a real estate license. Your IRA buys property and you want to get the 3% buyer's agent commission for your IRA buying the property. You just benefited from your retirement accounts investment. If you accept the commission, then that would cause a prohibited transaction. Now, you could reduce the purchase price to essentially get a credit for the commission, that the IRA gets a discount on the purchase, but you can't personally make the money. Yes?
So if you use that same scenario with your Airbnb,
Yes.
and no one was staying there that week, could you pay to go there, or you couldn't even stay there at all because that money would then go towards you anyway, right?
Exactly. See, exactly. That's exactly the problem.
You don't have anything to do with it.
either way, you're screwed. Because if you stay there and don't pay for it, it's self-dealing, right? Because you're unfairly benefiting. If you stay there and do pay for it, well, you're a disqualified person paying your IRA. So it's prohibited that way.
What if you stay there and don't tell anyone about it?
If you stay there and don't tell anyone about it, it's attorney-client privilege. I'm not going to tell anyone. So, but it's like anything. It's your obligation to report your taxes and all that stuff in a fair way. So, it's not like there's prohibited transaction police out there, except that you're just subject to audit. Okay, let me just make a couple points on family. So, if you notice on this list, there's a lot of family not on here, brothers and sisters. Your retirement account could loan money to your brother or sister, okay? I have a lot of clients that are real estate investors that partner with their siblings. They may have a brother or sister or someone that they partner with or do deals with, and that's fine. You guys can transact between each other all you want. Brothers and sisters are not on the disqualified list. Aunts and uncles. Also, now when you go down the family line, you pick up in-laws. So my oldest daughter is 20, if you can believe it. She goes to the University of Arizona. She's got a boyfriend. His name's Eric. I actually like Eric. He's a good kid. But let's say they get married one day, okay? And Eric comes to me and he's like, Dad, or whatever how that works. He's like, I got this real estate deal, I just need like 50 grand to cover the rehab. Do you want to loan me 50 grand from your IRA? I'll give you some interest and stuff. I'm going to say, Eric, you're a disqualified person. You married my daughter. You are a spouse of a child of mine. You're disqualified to my IRA. I cannot lend you money. So I'm actually off the hook there, right? So, but let's take a different scenario. Let's say my mother-in-law comes to me and says, Matt, I need a place to live. I want to sell our house. We're going into retirement. Can you just buy me a house and I'll rent it from you? Now, I could tell my mother-in-law yes, because in the rules, ancestors are what are considered prohibited, which includes your parents and your parents and grandparents. But the rule says ancestors. It doesn't say your spouse's ancestors, so you don't have to pick up your mother-in-law and father-in-law. So my IRA could transact with my mother-in-law, okay? It never will, but theoretically it could, okay? So just think when you go down the family line, you pick up in-laws. When you go up your family line, you don't have to include in-laws. And think of it as your own IRA. Your mother-in-law, father-in-law, your IRA could transact with if you're crazy. Down the family line, even if you want to transact with your son-in-law, daughter-in-law, it's prohibited. This is a fancy little diagram that says that. Okay. The Government Accountability Office, who basically, is a watchdog group and polices the IRS for many issues, they did a report on self-directed IRAs that came out in 2017. I consulted with them on the report, actually. They used my book as well. They came out with this diagram to kind of illustrate some points that you cannot do with a self-directed account. So if you have an IRA, you can't rent it to certain relatives. Remember, this would be your kids, parents. Your mother-in-law's cool, actually. You can't personally pay for repairs. This is another issue sometimes we see. Somebody's IRA has a rental property it owns or a piece of real estate, and they personally pay the property tax payment. That's a problem. You don't own that. Your IRA does. Your IRA needs to pay the expenses on it. So you have to keep your retirement account separate from you. That's the most important principle. Yes? Let's say you're invested in a fund and you need to put in capital. You hope you have enough money in your IRA.
But if not, you can't do it.
Or if you're not, you're going to have to tell them, sorry, I can't do it. I mean, maybe you could roll over money or make a new contribution, but if you've depleted all those options, you're SOL. Yes?
Just make sure I understood right. So flipping properties within the IRA does not work if you're the one doing the work.
Correct. You can be there and be like general contractor, just don't pick up a hammer. Like you can be there and make sure all the subs are doing their stuff, and you hire them and manage them and oversee them, and you can do the paperwork and everything. We just don't want you physically putting in services or labor. Since you guys brought up flips, this is a perfect transition to the second thing you need to know. Like for me, I consult with clients all day long on deals. Can I do this? Can I do that? How do I structure this? What do we do? And so that's like my job, that's what I'm doing. I'm helping all of our clients do the transactions they hope to do with their retirement account. And 99% of the questions boil down to prohibited transactions, which we just talked about, and UBIT tax, which we're going to talk about now. So there's a tax called UBIT tax, unrelated business income tax. And this is a tax that applies to retirement accounts when they receive business income. So retirement accounts are designed to receive investment income. If you get investment income in a retirement account, you don't have to worry about UBIT. And investment income is like rental income, capital gain income, interest income, dividend income. That's the type of stuff you want to get in a retirement account. If you get that, don't worry about this anymore. But if you're getting business income like flips or real estate development, you can run into this tax. Now this tax came about like back in the 50s or 60s, and what was happening at the time is a lot of nonprofits in New York City, like New York University, and there's some museums, were opening restaurants in New York City. And they were opening them because all of their people that attended their stuff, they wanted to just have a restaurant for them. Well, the restaurant industry in New York City got all pissed off, and they're like, this isn't cool. These are nonprofits starting restaurants that don't have to pay taxes, and I'm right across the street paying taxes. And I have to compete with them. And so they went to their representatives in Congress, and the representative in Congress said, you're right, that is not fair. We are going to create a tax and tax them. So they created a tax. It's called UBIT tax. So it was first applied to nonprofits, and they basically applied it to a nonprofit when the nonprofit did something that had nothing to do with being a nonprofit. So NYU is a university. If NYU wants to have a restaurant, fine, but that's not a nonprofit. The nonprofit has to pay tax on that. You want to be a museum and have a gift shop? Great. The museum doesn't have to pay taxes on your fees and whatever, but whatever you make in the gift shop, you're paying taxes on. Okay, and that tax is called UBIT tax. So when retirement accounts came out, they said, let's apply the same tax on retirement accounts. If you get investment income, don't worry about this tax. But if you get business income and you're competing with business, you have to pay the UBIT tax. So for real estate, really the key one is flipping, construction, and real estate development. Now, for flips, if you flip a few properties a year, don't stress about this tax. We're talking about a significant number of transactions where the IRS would look at your IRA and say, oh, your IRA is like a real estate developer or a builder. It's doing so much real estate transactions. It's in the business of real estate. So if you're doing 1, 2, 3 flips a year, I wouldn't stress about this UBIT tax. If you're doing more than that, though, you're flipping a lot of properties in your retirement accounts. And I have some clients here I know that do this. And they have to stop when they get to 3. Because if you start doing 4 and 5, now all of those get subject to UBIT tax that you did through that year. So if you hit 3 for the year you've done in your IRA, do the 4th one with personal funds or in your S Corp or whatever you may do flips outside of that. Yeah. The UBIT tax rate, it was just reduced by tax reform, thank you Donald Trump, to 34%. It's still a crappy rate. It used to be 39, so you want to avoid it. Now, if you're doing deals, I have clients that have done real estate developments and are doing them now still with retirement accounts, primarily with Roth IRAs. They know they will have UBIT, so they do what's called a blocker corp, where we have the retirement account own a C Corp, and the C Corp does the real estate deal, and we pay C Corp taxes, which are 21%. The short story is avoid this tax if you can. If you're going to get hit with it, there are some tax planning stuff to chop it down. All right, for notes, if you're doing a lot of hard money lending, like you're doing private loans and notes, no matter how many notes you do, you don't need to worry about UBIT. The IRS had a revenue ruling on this, 79-349, that basically said no matter how many loans you do with a retirement account, even if you may look like you're a bank, you're still exempt from UBIT. You get the interest income exemption. So it's more like short-term flips. Also, you could have as many rentals as you want. You're still fine. The short-term flips is the volume one that causes the UBIT tax issue. Okay. All right. Any questions on UBIT tax? Good, because I don't want to talk about it anymore. It's always like a bummer. It's like, oh, dang. Yeah. I do not have that much time, but I appreciate the question. If you want to know about, there's what are called solo 401ks. It's a chapter in my book that's another self-directed retirement account that can avoid a tax we'll talk about in a sec called UDFI. But Randy asked sorry, I will not get to that question. Okay, IRA LLCs. I'll stay after, by the way. I'll be out in the hall. If anybody's like, what's he talking about? I'll be back there. Okay, there's a strategy called an IRA LLC. Some people call it a checkbook control IRA that is used to buy multiple assets, or it may be used, I have a bunch of notes here. This could be multiple rental properties. It could be a rental and notes. It could just be one asset. But a lot of people, rather than having their IRA own a note or their IRA own a property, they'll have their IRA own an LLC 100%, and the LLC then owns the assets, like the rental or the note. So for example, this is Matt Sorensen IRA, this is MNS Real Estate LLC, and this is a rental property, this is a note, and the LLC just owns those directly. The tenant on the rental pays me rent to my LLC. The borrower on the note just pays the payments to my LLC, and I can build it up in the LLC. Now, if this is MNS Real Estate LLC, I don't own the LLC. My IRA owns it 100%, but I can be the manager of the LLC. Manager of the LLC is like president of the corporation. So I can sign for everything with the LLC. I want to go cut a deal tomorrow. I want to buy a property at auction in a couple hours. Knock yourself out. You're manager of the LLC. You have authority on the bank account. You can sign contracts. You can receive income. You can pay bills. You can send out wires. So you're really in a lot of control with an LLC. And in a lot of states like Utah, for example, they're very cheap. Like the annual fee is like $20. Your state filing fee is about $70. Our fee to set it up in our law firm is $800. But some states like California, it's like $800 a year just to have an LLC. So what happens here is, again, you have a self-directed IRA. It owns an LLC 100%. So now the only asset the IRA owns is MNS Real Estate LLC. MNS Real Estate LLC could own 20 different assets. So it's a way for you to have greater control, manage expenses, conduct transactions faster. You can sign and do everything, and you're just signing for the LLC as the manager. Any questions on LLC here? Yeah.
So you basically have one funding event in
Yes.
LLC from your perspective.
From my IRA,
LLC,
yep.
And that's the end. And
Yep.
you just manage everything until, let's see. So then if I ever want to pull cash out,
Yes.
after I'm 59 and a half,
Great, yes. Now let's say you've got a bunch of cash sitting in here in the LLC's bank account, because it's just going to have an LLC business checking account. You want to take cash out now. You've reached 59 and a half, which is how old you have to be to start pulling money out without penalty. What you'll do is you'll send a check back to us, to your IRA. We deposit in your IRA account, and then you request a distribution. We send you a check or wire from your IRA. So that has to go. You can't just cut yourself a check from the LLC, because remember, you don't own the LLC. Your IRA does. So it's got to go back to your IRA, and we're going to get it, and we're going to record keep it on your account, because we report it to the IRS, because there's two things we got to send the IRS when you do that. And so and whoever your IRA custodian does, they're going to track that and record keep it for you. Yes?
Can you do the opposite and like annually max out your IRA and then funnel that into the
Yes.
LLC?
Yes, exactly. So let's say you funded this in 2019, and you're like, all right, I'm going to make contributions later in the year or next year, and I want to invest those additional dollars. Yep, you'll just contribute here, and then instruct your custodian, like us, for example, to say, invest these additional dollars to the LLC. Yes?
Can your LLC pay you as a manager? Pay yourself as a manager of salary?
No. There's a case called Ellis versus Commissioner. It was an IRA LLC structure. Guy was paying himself a salary. The IRS said it was prohibited because he was benefiting by paying himself. So we've always said you couldn't do that. It's a restriction in our documents. And so an IRA LLC document is a little different than a regular LLC. You know, in an IRA LLC, there's going to be restrictions on what the IRA can and can't do, because it's built a little different than a regular LLC. But yeah, you can't pay yourself. You pay your brother or your mother-in-law. Yes.
Matt, checkbook control controversial, yeah?
The question was, is checkbook control controversial? Only amongst people who like to raise controversy. The IRS doesn't care. I mean, there's a lot of people in the industry that there's probably like 30 self-directed IRA custodians out there, and I'd say like of the 30, 20 to 23 of them allow you to do an IRA LLC where you're the manager, and then maybe 7 or so don't. So there's many reasons why some of them don't, but you can. Yes?
If you're helping a client set that up, do you set up both the LLC and the IRA, or can the client go set up the LLC on their own and make sure it's titled correctly, or is that part of that? You mentioned like say you
Yeah.
set that up.
So you would need a lawyer to set it up generally. It doesn't have to be us.
This is both the IRA and the LLC, you're saying?
Yeah, so there are two different things. So the one is the IRA. You have to have the IRA account. And that would be directed IRA. That's our company that does that. Then second would be the LLC. You need to have some lawyer do it, or you need to make sure the documents are really right for an IRA LLC. And we do that in our law firm for $800. So we're kind of a one-stop shop, you know. But they're two separate services. Okay, Aaron, you tell me when you're...
We probably didn't get Aaron up there because it's
Okay,
time to be done.
okay. You get the last question. You get the last question, yeah. Yes. So we're a trust company regulated by the Arizona Department of Banking. So central banks here in Utah, the only other one that there used to be American Pension Services, which went into receivership, that was here, which was not good. So you want to work with someone who's regulated. Whether it's a bank or a trust company, we're audited and examined by the banking department just like the bank is. We have outside audits by independent CPAs. So there are some people in the industry called third-party administrators. If you're looking for a custodian and you're like, I don't want to use directed IRA, whoever you're using, just make sure they're regulated. So if they're a trust company or a bank, they're regulated.